This is Candice Paine for BizNews, and I'm speaking to Wikus Furstenberg, who is a portfolio manager at Futuregrowth Asset Management. And today we're going to talk specifically around the current account deficit. The first quarter current account deficit widened to 5% of GDP, which is up on the previous quarter. And Wikus has concerns around what that means for our economy and the impact that the global economy has on that deficit for us. Wikus, let's talk a little bit around first of all, the composition of what is making up that deficit.
Candice, I think maybe firstly to point out that we tend to focus on the trade account part of the current account, which obviously refers to visible goods, imports, exports of stuff that you can see. And then the second part, which doesn't always sort of get the same sort of attention, is the services account that consists of your income and current transfer payments and other services, i.e. sort of the so-called invisible part of the current account deficit. And what's interesting, if you look at the developments over the last few years, I mean, the services account as a percentage of total has increased dramatically. I mean, currently the size of the services account deficit is about 3 times the size of the trade account deficit. So it's an important part of the current account deficit.
So this is money we're paying to other people?
It's money that we pay to other people, yes. I mean, and one of the reasons, and we all know that what happened in the first quarter of this year, is that there was a big decrease in payments back to South Africa, dividend payments. So the net dividend payment number made a big difference in terms of widening the current account deficit to a number that was sort of a surprise to the market. Within that, and I think that is something we need to keep an eye on as well, is the so-called net interest payment, i.e. the portion of interest rates that go offshore, which is a negative number, i.e. we pay out more than what we receive in terms of interest rates. And again, I just want to clarify that this excludes dividend payments. And if you look at numbers, rand billion, which is nominal, it's not real, it's sitting at just short of 80 billion at the moment, which is like a 300% increase from the level in 2010 or so. As a percent of GDP, that net interest payment is now sitting at around 2%. So it's a significant portion. And part of that, obviously, we can link to foreign holdings of SA rand-denominated debt, government debt in particular. So we're all very excited to see foreigners or portfolio inflows because it helps us through the capital account to fund this current account deficit. But it's coming at the moment it's coming at a heavy cost because interest payments are going offshore. So it's not something we can ignore. I don't think there's much we can do about it, but I think it just makes the point that we remain very vulnerable in terms of our external account, especially considering what's happening or not happening globally, generally in terms of growth. Export destinations are all basically battling with growth, and given what's been happening recently, including Brexit, but not only Brexit, the inability to fix the problem to get growth back at higher levels, even in the presence of negative interest rates or negative interest rate policies, that's a big concern to me, which in turn leaves us very vulnerable in terms of exchange rate volatility.
So if the good portion of our current account deficit, which is the trade, is smaller than the services, what options do we have to try and close that, to try and reduce the current account deficit over time?
I think the only thing I can really do at the moment is to try and manage imports of consumer goods. What you want to import are those things that will improve infrastructure. Transnet needs to import those locomotives. We don't mind that. Eskom needs to import generators. We don't mind that. But the flat screen TVs and all that, that's probably the place where you need to sort of cut. That's the easier way. In terms of exports, obviously, you need to export more, but it's easier said than done because a number of things need to happen for your export number in terms of volume to increase significantly. One, there's not much we can do about export destinations. Two, it's also about business confidence locally.
And let's talk about the impact of global economic growth on that current account deficit. If one of the things that we want to do is increase exports, our export partners need to be healthy as well.
Yes.
So even though the rand has had quite a rough ride over
Yes.
the last 6 to 8 months, that doesn't seem to be having an impact on that current account deficit to the extent that we'd want it to.
Definitely so. I mean, we've seen some improvement coming through, and some of us got excited by some of the motor industry sort of export numbers. But I mean, I think it's not really making a big difference, is it? Because the current account deficit is still hovering somewhere between, if you look at the last few quarters, 4 and 5%. And even if it sort of improves a little bit, it's not going to help. At 3%, we still need to fund quite a big gap. So we are worried about global growth. We are worried about the ability of us to grow volume to those export markets. And there's a positive price effect, sure, but you still need growth on the other side. And then, of course, as I mentioned, you should be equally concerned about business confidence on the local side. And, you know, government has a role to play there to make life a little bit easier, to create a little bit more stability and create a little bit, or to help to add to an improvement in business confidence. And we're battling with that at the moment. There's political uncertainty is not helping at all.
No, we certainly are, and you can see the effect of that in the rand. What does it mean for an economy like ours to have a sustained large current account deficit if we can't change this in the short term?
It's this. The first thing that's supposed to respond to that is, and we are running with a free floating exchange rate regime, is currency weakness. The currency need to adjust and will keep adjusting in response to this big gap.
So we're saying the rand is almost a one-way bet.
I'll be hesitant to sort of say that, but it certainly makes life very difficult for a currency bull or rand bull with a current account deficit that just doesn't want to sort of close to more sustainable levels, which are probably south of 3%, I would think.
So are we looking at further interest rate increases as we import inflation with this weak currency?
That clearly is a next possibility. At the moment, we know that the central bank is sort of fairly sensitive to growth as well. And we would be surprised if they sort of overreact by hiking interest rates aggressively. And there's even talk in the market that maybe we've seen a peak and maybe we're going to see sort of some policy easing next year. However, if the currency remains volatile, obviously it makes it very difficult for them to do that. So at best, don't expect interest rates to fall over the next year or so. And the worst case scenario obviously is one where actually they're forced to tighten policy more than they've done so far this year. Simply because, as you said, there's a cost thing involved here. Weaker currency, somewhere it's finding its way into prices, and need to manage inflation expectations ahead of those developments.
And so in the context of the downgrade that we didn't get last month, with things looking worse from a current account point of view, if interest rates are potentially going to rise, the currency is potentially going to weaken going forward, what does that mean for the potential of our debt rating in December when we revisit that?
I'm less concerned about that. We always sort of said we expect a downgrade. The timing of that obviously was uncertain. I'm more worried about growth. I'm more worried about the ability of us sort of generating higher growth, getting closer to our potential growth rate and creating permanent jobs. The current account deficit and currency volatility obviously doesn't help, but to me it's not as important as the first point. Okay. So we're sticking to our view that there's a significant risk for a downgrade over the next year or so by one or more of those rating agencies.
Wikus, thanks so much for your view on the current account. It doesn't sound like good news, but we'll watch this space.